In this video, we start discussing chapter 14, liquidity risk. We have a couple of main learning objectives in this chapter. So first of all, we will discuss what do you mean by liquidity risk and its sources. We will see that how liquidity risk arises from both the supply and the demand side, I mean from the liability and asset side, and we will see how financial institutions manage their liquidity, and finally we will see how financial institutions, particularly depository institutions, measure liquidity risk exposure. First of all, unlike other risks, for example, as we discussed previously, interest rate risk, credit risk, market risk, sovereign risk, or foreign exchange risk, these risks threaten the solvency of a financial institutions. Liquidity risk, on the other hand, is a normal aspect of everyday management of a financial institution. For example, the depository institutions must manage liquidity so that they can meet their obligations to depositors, like cash withdrawals and the needs of borrowers, for example, loan commitment. Only in extreme cases do liquidity risk problems develop into solvency risk problems, wherein financial institutions may not be able to generate sufficient cash to pay creditors as promised. We also discussed it previously that depository institutions, insurance companies, and other managed funds are exposed to different degree of liquidity risk. Depository institutions are have the largest exposure to liquidity risk. Life insurance companies are in the middle, and other financial institutions, for example, managed funds, superannuation, and general insurance companies are least exposed to liquidity risk. The global financial crisis in 2008 was partly due to a liquidity risk, as mortgage and mortgage-backed securities market in the United States started to experience large losses. Global credit markets froze, and banks stopped lending to each other at anything but higher overnight rates. The overnight rates, which is the London interbank rate, the most commonly used, was more than doubled. So in this type of the crisis situation, the financial institution may be more exposed to liquidity risk. Now, as indicated earlier, the liquidity risk can arise for two reasons. One is the liability side reason, another is the asset side reason. The asset side reason liquidity risk arises typically for supplying off-balance sheet loan commitments. As we previously learned, that a loan commitment allows a customer to borrow funds from financial institutions on demand over a commitment period. So when a borrower draws on its loan commitment, the financial institution must fund the loan on the balance sheet immediately. And this creates a demand for liquidity. So if financial institution doesn't have enough liquidity to honor the drawdown or the takedown demands for the borrower, the loan commitment borrower, the financial institution may lead to a liquidity problem. The liability side reason occurs when financial institutions' liability holders, such as depositors or insurance policy holders, seek to cash their financial claims immediately. So when liability holders demand cash by withdrawing deposits, the financial institution needs to borrow additional funds or sell assets to meet the withdrawal. The most liquid asset is cash. Financial institutions use these assets to pay claim holders who seek to withdraw funds. However, financial institutions tend to minimize their holding of cash reserves as assets because these reserves pay no interest. To generate interest revenues, most financial institutions invest in less liquid or longer maturity assets, while most assets can be turned into cash eventually. For some assets, This can be done only at a high cost if the assets must be liquidated immediately. The price of asset holder must accept for immediate sale by far less than it would receive with a longer horizon over which to negotiate a sale. Thus, some assets may be liquidated only at a low price, which is known as fire sale price, thus threatening the solvency of the financial institutions. Alternatively, rather than liquidating assets, a financial institution may seek to purchase or borrow additional fund to meet its liquidity needs. In reality, a depository institution knows that normally only a small proportion of its deposits will be withdrawn on any given day. So most demand deposit act as consumer core deposit on a day-by-day basis, providing a relatively stable or long-term source of savings and time deposit funds for depository institutions. Moreover, deposit withdrawal may be in part be offset by the inflow of new deposits and the income generated from the depository institution on and off balance sheet activities. The depository institution's manager must monitor the resulting net deposit withdrawal, which is popularly known as net deposit drains. So net deposit drains is the amount by which cash withdrawal exceeds the inflow of deposits. Specifically, over time, a depository institution manager can normally predict with a good degree of accuracy the probability distribution of net deposit drains on any given normal banking day. So as we discussed that assets and liquidity risk arises when the banks have a large amount of off-balance sheet loan commitment, and the liability side liquidity risk arises when the liability holders immediately the claims withdrawal claim, they try to withdraw their claims. Now, a depository institution can manage a drain on deposit in two major ways. One is the purchase liquidity management, another is the stored liquidity management. Traditionally, depository institutions managers have relied on stored liquidity management as the primary mechanism of liquidity management. Today, many depository institutions, particularly the large financial institutions with access to global money markets or other non-deposit markets for funds, rely on purchase liquidity management to deal with the risk of cash shortfalls. So we will briefly discuss about purchase liquidity and stored liquidity now. First of all, the purchase liquidity management. A depository institution's manager who purchases liquidity turns to the market for purchase funds, such as funds borrowed from competitor banks through the interbank market and other institutional investors such as life insurance companies or repurchase agreement market. Alternatively, the depository institution manager could issue additional fixed maturity certificate of deposit or even sell some longer dated notes or bonds. However, we need to understand that borrowing from the outsiders can be expensive for depository institutions since it is paying market rates for funds in the wholesale money market to offset net drains on low interest bearing deposits. Thus, the higher cost of purchase funds relative to the rates earned on asset, the less attractive becomes this approach to liquidity management. Note that purchase liquidity management has allowed the depository institutions to maintain its overall balance sheet size without disturbing the size and composition of the asset side of its balance sheet. We will see an example in the next slide. That is, the complete adjustment to the purchase liquidity management can insulate the asset side of the balance sheet from normal drains of the liability side of the balance sheet. So this is one of the reasons for the enormous growth in the recent years of the financial institutions' purchase liquidity techniques and associated with fund markets such as interbank funding, repurchase agreement, and so on. So here is an example of purchase liquidity. First of all, before liquidity drain, look at the balance sheet. Asset is $100 and liabilities are deposit 70, borrowed fund 10, and other liability 20. So a depositor wants to withdraw $5 million. So you can see that deposit declines by $5 million. So this is the liability side after the deposit drain, which you can see that which is the $5 million lower than the asset side. Now, if a financial institution depends on purchase liquidity, so financial institution or manager will turn into the borrowed market to borrow this net deposit drain. So a financial institution manager borrow $5 million from outside market, maybe from call money market, interbank market, or maybe from repurchase agreement market. So now the liability side is again $100. So you can see the point I was just mentioning that in the case of this the purchase liquidity, the financial institution manager can maintain its overall balance sheet size without changing the size or the composition of the balance sheet. So it can insulate the asset side of the balance sheet from normal drains on the liability side of the balance sheet. Now, stored liquidity management, instead of meeting the net deposit drain by purchase liquidity in the wholesale markets, the depository institution could use stored liquidity management. Right? So stored liquidity is actually an asset side adjustment to the balance sheet to cover a deposit drain. So financial institution can liquidate some of its assets to face its net liquidity drains. Traditionally, depository institutions have held cash reserve at their central bank and at their vaults for this very purpose that can be used to cover up the net deposit drains. So here is an example for stored liquidity. You can see that this is the balance sheet before the net deposit drain. So a financial institution has an asset of $100 million, where cash 9 million and other asset 91 million, and deposit is 70, borrowed fund 10, and other liabilities 20. Once again, the depositor withdraws $5 million. So you can see that deposits declined by $5 million. Now, since the bank has cash of $9 million, which is sufficient to cover this net deposit drain, so the bank uses its cash to pay out this deposit withdrawal. However, you can see the difference that previously the balance sheet size remained the same when the bank used purchase liquidity, but now the balance sheet shrinks as the cash is liquidated to pay out the net deposit drains. So this is the end of our discussion about the sources of liquidity and how stored and purchased liquidity is used to manage liquidity. So in the next video, we will discuss measuring liquidity risk exposure for depository institutions. Thank you very much.